Will Ethereum hit 10, 15, maybe even $20,000 by 2025? You see these predictions everywhere, and honestly, it's easy to get lost in all the hype. But what if the real story isn't just about the price? What if something way bigger is happening right now, kind of behind the scenes? To get what's really going on, we gotta look at who's making these wildly different predictions in the first place.
So on one side, you've got the crypto influencers out there calling for a five-figure Ether price. But on the other, you have these financial heavyweights like Galaxy Research with forecasts that are, let's say, a lot more down to earth. I mean, look at that gap. A crazy $20,000 versus a much more sober $5,500. It's the classic crypto face-off, right? Moonshot hype versus Wall Street realism.
So this begs the real question. Are we just watching another hype-fueled bubble inflate, waiting to pop? Or is there something more solid, more substantial driving the market this time around? To figure that out, we need to look past the flashy price tags and see who's actually doing the buying.
Okay, let's dive into that prediction frenzy. While all the headlines are screaming about these huge price targets, the real story isn't about the what, it's about the who. And the data is showing a massive fundamental shift in who is actually in this market now.
And this is really the core of it. Something fundamental has changed. Seriously, the conversation has totally moved past if institutional money's in crypto. They are here. So the new, much more important questions are, who exactly are they and why now?
Right, so let's meet these new players, because this isn't just a couple of adventurous hedge funds dipping their toes in the water anymore. No way. We are talking about a seismic shift that's pulling in the entire spectrum of traditional finance.
Just get a load of this one single, powerful number from a recent survey by Coinbase and EY Parthenon, 86%. Okay, that's the chunk of major institutional investors who are already in digital assets or are planning to be this year. This is not a fringe movement anymore. This is a full-on mainstream financial strategy.
And we're not just talking about one type of institution. The list of players includes asset managers, hedge funds, private banks, venture capital, even the more conservative family offices are in. Basically, the entire spectrum of what we'd call smart money is now in the game.
Okay, so they're here. We've established that. But why? What is driving this massive institutional wave into what, not too long ago, was considered the Wild West of asset classes? Let's crack open their playbook and see.
It really boils down to three key drivers. Number one, no surprise, higher returns. Nearly 60% of them are chasing better yields than they can get elsewhere. But look closer. This is interesting. Almost half are investing because they see it as truly innovative technology, and 41% are using it as a hedge against inflation. This is not just a gamble. It's a calculated, pretty diversified strategy.
But of course, it's not all sunshine and rainbows. They're not going in blind. Their biggest fear, topping the charts at 52%, is the uncertain regulatory environment. They're also, still wary of that classic crypto volatility, and they have concerns about keeping the assets safe. This balance of ambition and anxiety is really what defines their whole approach. They see this massive potential, but they are moving with a ton of caution.
So what changed? What finally convinced these cautious giants to take the plunge? Well, it wasn't just one thing. It was more like a perfect storm, a convergence of three really powerful catalysts that made this whole wave possible.
You can basically think about this institutional adoption in three steps. Step one, ETFs came along and opened the floodgates, creating a simple, regulated highway for money to flow in. Step two, critical tech upgrades made the network, the plumbing, actually work reliably. And step three, real-world utility started to move way beyond just speculation. Let's break each of those down.
First up, the floodgates, those exchange-traded funds or ETFs. The launch of spot Ether ETFs was an absolute game changer. We're talking nearly $9 billion in net inflows in just 1 year. And the pace is picking up, with a record $1 billion inflow on a single day back in August. For 60% of these institutions, ETFs were the simple, regulated buy button they had been waiting for.
Next, the engine room. The tech itself has to work, right? It has to keep up. So recent network upgrades like Pectra have made it way easier for institutions to manage their accounts and earn better returns from staking, which is kind of like earning interest for helping to secure the network. And the next big one, Fusaka, is set to slash transaction costs, turning Ethereum into a truly efficient industrial-grade platform. And finally, utility. This is where it gets really interesting. Institutions are moving beyond just staring at price charts and into real applications. They're exploring decentralized finance, DeFi, which wants to rebuild things like lending on the blockchain. They're using stablecoins for payments and to earn yield. And they're laser-focused on tokenization, the idea of putting real-world assets, like a piece of real estate, onto the blockchain. This is where the technology starts to actually reshape finance itself.
And check this out. DeFi engagement is set to absolutely triple. Right now, about a quarter of institutions are using it. But hold on, another 51% are planning to jump in over the next 2 years. That signals a massive shift from just passively investing to actively participating in this whole new crypto economy.
So let's put it all together. When you step back and look at the big picture, what does this new reality actually mean? For crypto, for finance, well, it's a lot bigger than just another up and down market cycle.
What this all adds up to is a really fundamental structural shift. This isn't just another crypto bull run. It's not the same old story. The big idea here is integration. Digital assets are being woven into the very fabric of the global financial system, creating this new kind of hybrid model.
And that brings us to this really fascinating paradox, which is captured perfectly in the Coinbase report. The single biggest thing these institutions are afraid of, regulation, is also what they see as their single biggest opportunity. Why? Because getting the rules right is the final key that could unlock trillions more in capital. It's the ultimate double-edged sword for 2025.
And that leaves us with one final massive question. We've seen this merger begin in trading and in asset management. But as this integration keeps accelerating, you have to wonder, what comes next? From the way we pay for things, to lending, to real estate, art, the line between the old financial world and the new digital one is getting blurrier by the day. What part of our world will they reshape next?